G'day, and welcome to another episode of This is Investing. I'm your host, Vince Scully, and today we're talking all things indexes. And starting with, well, what is an index? And it's really just a way of answering the question, how is the market going? It's also a great way of tracking your performance, and more recently, it's been a way to construct portfolios. And today, we're going to discover why that's relevant to you and your portfolio. But that's after this. So indexes in one form or another have been around for as long as we've had stock exchanges. And that means we're going back to the 16th century. So the Royal Exchange in London opened in 1571. And interestingly, stockbrokers weren't allowed inside because they were too rowdy. So they used to trade shares around the corner at Jonathan's Coffee House. I think that Jonathan Swift. And the stockbrokers were only eventually allowed in when the exchange was rebuilt after the Great Fire. And then, of course, shortly after they moved around at the end of the 18th century, so 1773, they moved around to the site of the current exchange. And back then, the only real way to track what was happening in the market was to sit there in the coffee shop drinking coffee. And that meant that knowledge was power. In the first official stock exchange, the Amsterdam Stock Exchange, set up in 1602, at first, it only traded shares in the Dutch East India Company, but over time, more and more added. And but still, you had to be there to know what was happening. And so that is the knowledge really was power. The New York Stock Exchange was where the index saw the light of day first. So the New York Stock Exchange started with 24 stockbrokers in 1792, and that eventually became the New York Stock Exchange. But only those 24 brokers knew what was going on. And so outsiders, that is the mug punters who were buying the shares, needed a way to know what was happening. So 1884, Charles Dow launches his transportation average, which was just the average of 12 stocks. 12 years later, that became the Dow Jones Industrial Average, which covered the similar number of shares, and eventually that was increased to 20 shares in 1916 and to 30 in 1928. But of course, the technology back then meant that the index could only be calculated daily. And the Dow, which is still calculated today, still contains 30 stocks, is different to almost all of the other stocks. So it's simply the average price. It ignores the market capitalization of the company. So a dollar change in a $30 stock has a bigger impact than a dollar change in a $60 stock, regardless of how many shares are on offer. And that's, as a function of the technology at the time, but didn't really have a practical it didn't really deliver what a trader really needs. Interestingly enough, if you put $100 in the Dow on the day that it was founded, you'd be sitting on $859 million today. That's the power of compounding. And from an index investor's perspective, the other interesting point is that the only original member that's still in the index today is GE. It's not quite the same GE, but it's physically the same legal entity. 1923, so 25 years later, Standard & Poor's launched the S&P 90, which, as the name suggests, included 90 stocks, and that became the S&P 500 in 1957. And technology had moved on at that point, so it was calculated hourly. Today, of course, it's calculated in real time. But back in 1957, technology really only allowed it to be done every hour. And the S&P 500 is the granddaddy of all indexes, it's the one that gets quoted most often. It accounts for probably 2/3 of all share value in the world. So it's a big deal. And the important point, I think, here is that although it's supposed to be the biggest 500 companies in the US, isn't actually the biggest 500 on the market. And that's because it's not a pure mathematical calculation. It covers 500 companies, but 503 shares. So companies like Google, for example, are on it twice. So the key ways that you get into the S&P 500, it's obviously got to be a US-based company with a significant share of its revenue and assets in the US. It does include some foreign companies, though, so Linde out of Switzerland, as an example, and these are companies that have fairly material presences in the US. Company's got to be a minimum size. Today, $22.7 billion in market cap is the ticket to join. Your shares have got to have a high volume, and at least half the shares have got to be available to the public. And the company must be profitable in the most recent quarter and for the aggregate of the 4 quarters before that. And that's really what stopped Tesla. So Tesla had been in the 500 biggest companies for years before it was joined the index. And this is an important point. So it's not just ticking all those boxes gets you into the index. You've also got to pass the committee. And so the committee focuses on less or more intangible things like market leadership and economic representation. And these are active decisions. So there is quite often a big gap between a company becoming one of the 500 biggest shares and it being included in the index. And the inclusion is telegraphed well ahead of time. So people know that it's coming. And these are changed every quarter in March, June, September and December of each year. And so that's those decisions and when they happen drive the behaviour of a lot of index funds. So an index fund is getting appraised based on its tracking error, so how closely it tracks the index, and therefore it wants to buy the new entrants on the close of business on the day it's entered, and prices tend to run up on that. So as a general rule, you would expect that an index fund with a low tracking error will underperform the market it's tracking, even if it tracks the index. So that's an interesting twist. Similarly, in London, the FT30 index was launched in 1935, so still a long time after the market was started, and that became the FTSE, the Financial Times Stock Exchange Index, in 1984. Australia was actually quite well up with this technology, even though we didn't get a national exchange until the 1980s. So Australian Stock Exchange dates back to the 1800s, so mid to late 1800s. Victoria 1861, New South Wales 1871. And there was even one in Launceston at one point. The main index the All Ords didn't turn up until 1980, but before that, each of the regional indexes had one, and the big one were the Sydney indexes. So the All Ords covers 500 shares, but for most practical purposes, it's been replaced by the ASX 200 or the ASX 300. As the name suggests, ASX 200 tracks the 200 largest, or 200 of the largest. So before that, we had the Sydney Commercial Industrial Index between 1875 and 1936, and the Sydney All Ords Price Index up to 1979. and then we had the All Ords. And globally, around the world, there's three main providers of indexes. Obviously, S&P, Standard & Poor's, the credit agency who really started out providing credit information to companies to know who they should be trading with and to bond investors to know the quality of what they're getting. So it's S&P. The other big one is FTSE Russell, so FTSE, Financial Times Stock Exchange out of London, and Russell Investments, the people who brought you the RARI ETF, and of course the MSCI, the Morgan Stanley Capital Investors. There are lots of smaller providers and lots of people who provide custom indexes, but when we're looking at globally, these are the main providers of global indexes. And when you're trying to look at how you're performing against the index or what returns you should expect, it's important to remember that all of these indexes, apart from the DAX in Germany, are price indexes. So they just look at the price of the share and they ignore dividends. And so when you're comparing the S&P 500 out of the US with the ASX 200 in Australia, there's a 2 or 3% difference in distribution. So be very careful with that. So that's really the history of the index as a performance monitor and a market health indicator. But more recently, and this is probably more relevant to most people, the index has become a great way to cheaply and efficiently build portfolios. And this is relatively new technology. The theoretical model for index funds dates back to 1960 at the University of Chicago. Two chappies called Renshaw and Felstein who created this idea of what they called an unmanaged investment company. And that didn't prove to be a particularly popular concept at the time. And we didn't really see it catch on until the very late 60s, early 70s. Despite what you may read on Reddit, Jack Bogle did not launch the first index fund at Vanguard. The first public offer index fund was actually a thing called the Qualidex Fund in 1967. Well, at least it was registered with the SEC in 1967, but it didn't actually get launched until 1972. And it was designed to track the Dow, which, as we talked about, is probably flawed as an index. The company was eventually bought by Templeton and shut down in 1984. John Templeton, possibly one of the best investors in history, had a particular distaste for indexes, so it didn't last very long after he acquired it. 1971, we're now starting to get real. So the Samsonite pension fund, the suitcase people, the guys at Wells Fargo who'd been doing most of the work on the technology behind indexes, got a mandate from the Samsonite pension fund to run an index fund, and this was an equal weighted fund of all stocks on the New York Stock Exchange. Equal weight indexes are much more complex and much more expensive to trade than market weighted index, and so it didn't really go all that well. But it was enough that by 1975, Jack Bogle comes along. He's been working at Vanguard, and they launched the first index investment trust. Well, it was Wellington Capital Management, but same thing. And this was widely derided around the market. It was called Bogle's Folly. It was considered un-American. And it became the Vanguard 500 Index Fund in 1990, by which time it had got $1 billion under management. Today, index funds are pretty mainstream. And as much as 50% of US equity funds are managed on that basis. In Australia, a bit lower, maybe a quarter, but it's certainly a big deal. And there is a lot of evidence that when it comes to particularly to large cap equities, that it's very hard to outperform consistently. There's a fair bit of academic work around this, but probably the most accessible work is Standard & Poor's, who obviously have a horse in this race, so you can't consider them to be unbiased or independent. But they publish a regular, either 6-monthly or quarterly, they publish a report called the SPIVA, which is the Standard & Poor's Index versus Active report, and it compares a very wide universe of active fund managers against the index. There are a few flaws with this analysis. So it assumes, for example, that the index can be bought for free, which if you measured index funds against that measure, close to 100% of them would underperform, at least by the amount of their fees and transaction costs. So the raw numbers aren't particularly meaningful, but they make for great headlines. But unsurprisingly, given the publisher, it shows that the majority of actively managed funds do not outperform the relevant index on a risk-adjusted basis. And that's an important lesson that we should all take away when it comes to investing. That stock picking, individual stock picking, is a notoriously difficult task to pull off, at least as an individual investor.
This is Investing is brought to you by Life Sherpa Invest. If you want your money to work harder and not just sit in a savings account earning crumbs, check out Life Sherpa Invest. Choose from 4 risk-based portfolios like Everest 90 with 90% in growth assets. Long-term, low-cost and built for people who are after serious returns. Invest from $5K today at lifesherpainvest.com.au/invest and start climbing.
But we do have to be careful with what conclusions we draw from this data. And the first is that most big funds are closet indexes. That is, they don't stray too far away from the index. You'll find that their managers use terms like tilts, overweight, underweight, and they're very much benchmark aware. So there's a lot of career risk in moving too far away from the index. And many research houses use tracking error as a measure of the quality of a fund. And that means that they're not doing something different enough to generate a materially different answer. That's not true for all, but when you look at them on a funds weighted basis, that the bigger the fund is, the closer it's going to be to the index as a general rule. And if you're not doing something different, you're going to get broadly the same result. And so if you want to get a different result, you have to do something different. And sometimes different is different bad, and sometimes different is different good. And being different and wrong is a career-damaging move when it comes to funds management. Being the same and wrong is a fairly safe place to be. Being the same and right is just what's expected of you. But being different and wrong is, or even being different right just too early, can be a career-limiting move. I recall times in the lead up to the GFC when we were managing portfolios of individual stocks, and we had a sell on some of the big names, Babcock & Brown, City Pacific, ABC Childcare, MFS. All of these were market darlings, and the newspapers, as it was then, loved them. And we were telling clients that they should be selling these, and we were getting a lot of kickback from customers. And we might have been a little early on that call, but these companies all disappeared in the GFC, leaving their investors with close to zero. So being early is sometimes as bad as being wrong. But there's no doubt about it that pulling off different good consistently, particularly in large cap shares, is a tough job to pull off. But nonetheless, according to the SPIVA report, despite all of its biases, shows that about 1 in 6 Australian large cap equity funds outperform over 15 years. They're not brilliant odds, but they're not that bad either. And there are indicators that will help you assess which ones are more likely to be in that target than in others. The odds are nowhere near that good in US equities. But I think the important point, and Spiva does a good job of this, is to make sure that you're comparing it to the right index. So if you're buying a small cap fund, it shouldn't be compared to the ASX 200. If you're buying a value fund, comparing it to the broader index is probably not a great comparison. And if you do that, you may find that you're just paying active fees for factored tilts. So you're looking for a fund that materially deviates from the index. And to do that, you're going to have to look at their philosophy, you're going to have to look at their holdings, you're going to have to accept a large tracking error, and you're really relying on the skills of the team. So if I had to give you a handful of things to look at, the first thing you're looking for is a high active share. So that's a measure of how different the holdings in that fund are compared to the index, and you want a high active share. But be careful with that. So if you look at most fixed interest index funds, they will have a high active share just because it's impossible to buy everything in the index. But when it comes to equities, a high active share is what you're looking for. You are looking for a relatively concentrated high conviction fund. So you want a fund that buys a small number of assets. If they're holding 200 holdings, they're going to start getting closer to the index. So you're really looking for a fund with 30 to 50 holdings, maybe even less. And you want a strong methodology as to how they're picking them. You're looking for statistically a thing called a low R squared. That's a low correlation to the benchmark, and you have to accept a high tracking error. You're also looking for a manager with a proven long-term track record, which sounds obvious, but you have to find one who fits that category and has a small fund, because the bigger the fund, the harder it is to outperform. And so you do have to accept the risk that you're going to have to invest in a fund that's small and growing with a manager that may not have in a fund that may not have a huge track record. So where the manager came from, so looking at a manager that was a portfolio manager at a bigger shop and then set up their own is often a good indicator. But working with a startup fund manager comes with risk that they might not be around in 2 years' time. So you've got some potential tax issues on exiting. There are a number of incubators where, so people like Pinnacle in Australia or Fidanti, who provide all of that technology, distribution, back office and systems for managers in return for some equity in the manager. And that can reduce some of this risk. But it's a tough gig to do. And all of that takes a lot of time, effort and skill. So when we deal at Life Sherpa with active managers, we will meet with the portfolio manager at least twice a year. And before we put them on our approved product list, we will have met with the team probably 3 or 4 times. And we'll have been through a series of analysis on their portfolios and their consistency with that. There are a whole bunch of research houses that provide this data. We look at the absence of a rating as a red flag rather than the presence of a rating being a green flag. And so you've got to know how to read these things, because nobody ever publishes a dud or failing grade review, and usually the manager's paying for the review. And so you do have to be careful with that. The other thing you need to focus on is, well, there are some markets where this is easier than others, and very clearly the small cap or small company market is where there's a lot of scope for a manager. So small cap equities, they're more inefficient. There's less analysts covering it, and there's less information, and getting access to management is easier for a manager. But clearly this is an area that offers a lot of opportunity for managers to find undervalued gems. Small cap companies are obviously riskier, but on average, they outperform big companies over time. Fixed income, so bonds, is especially as you move up the credit curve, as it be from a AAA government bonds through to lower credit rated corporates and unrated or private credit. Manager skill is huge here, and it's almost impossible to buy the index because the index will contain tens of thousands of constituents, and you just can't go and buy them all. So you will have, and necessarily even an index fund will be an active fund. Income-focused funds, another area where manager skill allow you to avoid what we call dividend traps. So stocks with high yields but poor outlooks, they will still show up in the index, in the yield index portfolios, and you want to avoid those. And clearly you want to be avoiding closet indexes, which is probably, if a fund's managing 10 billion in large cap Aussie equities, it's almost by definition a closet indexer. You want to be still looking after fees. And sometimes this can be a bit hard to analyse because the disclosure rules require that a performance fee, and most of these funds will have performance fees, get included in the reported MER or cost ratio, even though new entrants may or may not be paying that. So sometimes they can look more expensive than they really are. So you really want to be looking at what's my fee with and without the performance fee, and how is that performance fee calculated. And you want to avoid funds that hold a broad range. So if you're looking at an active Aussie fund that holds 100 stocks, you're probably looking in the wrong place. And so there is no doubt about it that it is easier to achieve market returns by buying an index fund within the more efficient sectors. And that should, as a general rule, form the core of your portfolio. However, and this is the bit that most people miss, that whilst market cap-based indexes are a great way to allocate capital within a market sector, like large cap Australian, large cap US, large cap Europe, large cap emerging markets, it is a terrible way to allocate capital between markets. So the fact that the US is 70% of global markets does not mean that you should be putting 70% of your money in the US. And that's the consequence of buying a global equity index. And just to illustrate that a little bit more clearly, the bond market, that's fixed interest, is 20% bigger than the equity markets looking around the world. And if I told you that you should therefore have a 55 bond allocation and a 45% equity allocation, you'd look at me and go, Vince, you are smoking something. And that would be a hopelessly inappropriate portfolio for most people listening to this podcast. And so great to build an efficient portfolio within an efficient market sector, terrible to allocate between sectors. So you need a different way to work out your asset allocation. And similarly, the gold market is 30% of the equity market. Should you have 30% of your money in gold? I would say clearly not. And that would certainly be an extreme position. So adding all that up, an index is really a way of answering the question, how's the market going? On its own, without the accumulation piece, it can give you a misleading answer. And it should usually be supplemented with some volume information and some indication of breadth. One of my favourite metrics for working out breadth is to look at what's called the advances versus declines indicator. So that's a measure of what percentage of shares went up today, or this year, or this month, or this decade, and what percentage went down. So, a strongly growing market will usually be indicated or will demonstrate growing index, growing distributions, broad growing volume, and a majority of shares in the advances category. That all takes a little bit more than looking at Yahoo Finance in the morning, which was going to show you the price index. Very important when we're looking at most media reporting around stock indexes, they're talking about a price index. And that's not what you get to spend. You get to spend the accumulation index. And that's what you should be looking at. That data is not that easy to get. You really need some professional tools to do that. Most of the free stuff is really just focused on the price index. And then you need an alternative means to allocate between market sectors. The other thing that an index is really useful for is to benchmark your performance. So you should be, if you're buying something other than the index, you should be measuring your performance against an appropriate index. And obviously, if your portfolio is 100% CBA, tracking that against the ASX 200 doesn't tell you an awful lot about your skills as a stock picker. Tracking against the bank index could be a better indicator, or tracking it against a value index could be a better answer. But the fact that CBA outperformed the ASX 200 over the last decade or two doesn't tell us very much about your skills as a stock picker. So compare yourself to an index, but make sure it's the right index. And then finally, the index is a great way to build portfolios in large, efficient, well-researched markets. So that's indexes. That's it for today. Tomorrow, or the next episode, we're going to look at how these funds get put together and how you can buy them. So for now, bye till next time.
Thank you for listening to This Is Investing. Any advice is general financial advice and does not consider your objectives, financial situation, or needs. You should consider whether the advice is appropriate for you before acting. Always read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs before buying any financial product. Vince Scully is a representative, and Simo Interactive, Pty Ltd, and Glenn James are authorised representatives of Money Sherpa Proprietary Limited, which holds Financial Services Licence 451289. And if you want further investing fun, the Quick Start Guide to Investing, as endorsed by Vince, obviously, is available wherever good books are sold, or there's a link in the show notes to get your copy today.